Everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, we're going to run through the most important charts and themes in markets and investing. And boy, do we have a lot to talk about this week. Let's dig right in. Of course, start with the run on the bank. So, bank failures past few years, we haven't heard very much about them. Zero bank failures in 2021, zero in 2022. Last time we saw 2 straight years without any bank failures, 2005, 2006. So, all of that really changed in a hurry last week. We now have the second and third largest bank failures in history. Silicon Valley Bank number two, Signature Bank number three, based on the size of their assets at the time of the failure. So enormous news here. And you had depositors, of course, panicking, worrying, are we going to lose access to our money? Anyone with under 250,000 was told very quickly, you'll have access to that money on Monday. But the people who had above that amount, businesses, many of them who had accounts in Silicon Valley Bank, it was quoted that roughly half of the startups in Silicon Valley have a banking relationship there. So a lot of businesses worried we're going to lose access to that money. Perhaps we're even going to have a haircut if ultimately the assets are less than the liabilities of this bank. But all of those fears are really put to rest on Sunday night, and the Fed, the Department of Treasury, and the FDIC made a joint statement saying essentially all of the deposits will be guaranteed regardless of your asset size. So if you have $500 million with Silicon Valley Bank, all of that is guaranteed, and you'll have full access to that as of Monday. And so what happened here? Let's take a step back. What happened with Silicon Valley Bank? Well, it was just a classic human psychology. Silicon Valley Bank announces that they've sold a portion of their bond portfolio and took a sizable loss, $1.8 billion. And they say they're going to try to raise equity to replace that loss and replenish that capital. And that really set off a downward spiral where you had people saying, we're worried about Silicon Valley Bank, so take your money out. And that very quickly led to just this huge rush of withdrawals. And it was reported that $42 billion in a single day of attempted withdrawals on March 9th. That was simply too much for SVB to meet in a single day. And there would likely have been more to follow because everybody's scrambling to get out at the same exact time. So once, of course, a bank has this massive rush of outflows, if they don't have all of their assets in short-term treasury bills, let's say, or cash, well, they can't meet that immediately. And the regulators, of course, decided that they needed to shut it down to have a more orderly situation. And ultimately, they ended up putting it into this new holding company, and depositors have full access to their money. So really, Silicon Valley Bank was just a question of game theory where people are saying, I don't want to be the last one out. So I don't want to take the chance in terms of what will happen. So I'm going to move my money now and ask questions later. And really, the big question was for that uninsured deposits, and pretty sizable. There's different reports, but I think a lot of them said over 90% of Silicon Valley Bank's deposits were uninsured, so above that $250,000 limit. And so really you had many businesses and individuals, well, not viewing that limit as really being a risk to them. They probably thought, I'm in this secure bank that's been around 40 years. I don't really have to worry about it. But very quickly that changed, and they began to worry about it. And I think that in the future, businesses will likely view deposits at a banking institution differently. So what are some things that people or institutions could have done? Well, of course, they could have had more than one bank account, probably a good idea for situations like this. Spread the risk around. You can obviously have multiple banks, but if you're a business that has, let's say, tens of millions of deposits and you're a bigger business, well, obviously, you're not going to have 1,000 different banks. What you could do there, of course, is have an account where you hold treasury bills, short-term treasury bills, for the majority of that cash and only transfer it to the bank, to, let's say, to meet payroll needs or other expenses when you actually need it. So don't hold money in that bank above that FDIC insurance limit unless you absolutely need to. So I think in the future that probably will be viewed differently. But what in the short term is going to happen with these other banks? That's the big question because in that joint statement, they didn't come right out and say if another bank fails next week, which people are worried about, and a lot of the regional banks that traded on Friday had huge declines, and the same thing on Monday. What happens if one of those banks fails? Well, it's not exactly clear that they'll do exactly the same thing. So we're likely to see probably additional withdrawals. And so, what did the Fed do to kind of protect against that, so that another bank won't have to sell its securities like Silicon Valley Bank did at a loss to meet depositors? And what they did was set up this bank term funding program, BTFP, they for short, and they essentially say here that if you bring let's say treasuries, agency debt, mortgage backed securities, like qualifying assets that are considered to be money goods. So you're going to get your money if you hold to maturity. If you bring these securities to the Fed and they're trading at a discount, let's say they're trading at 90 cents on the dollar or less, which many of them are because interest rates have risen, the Fed will give you 100 cents on the dollar loan for that, for those securities. And so you can therefore meet the needs of your depositors. Let's say if you have a rush of withdrawal requests, you won't need to go out and do a fire sale of those treasuries or mortgage-backed securities. You can hold on to them, pledge them to the Fed, and get a loan to meet deposit requests. Now, does that mean that a bank still won't be shut down or fail because of this? No, it could still happen, but I think it lowers the probability because they have the means to meet these depositors. But at the same time, if let's say you have a bank has $100 billion in deposits and 95 billion is going out the door, well, then really what's left of that business? So the business value of that bank, even if they're able to meet those depositors with these loans, that business value is going down in a hurry. And it's not clear that ultimately they wouldn't be forced to shut down anyway. But all that said, this lowers the risk of, let's say, another similar situation like Silicon Valley Bank happening, but it doesn't, of course, eliminate it because you have still until someone out comes out and says everything's guaranteed above 250, you will still have people saying, "I'm going to move my money and either hold that in treasuries or move it to a bigger bank that's deemed too big to fail, like J.P. Morgan Chase." And so, what are some things in the future that we can do to protect against this happening again? Well, there's a few things. Congress could raise that 250,000 limit. They could vote to raise it. They did it back in 2008. Perhaps they'll do it again today. What I proposed, one solution, what I proposed on Twitter is that when you open an account, that the end consumer who has that deposit amount above 250,000 can be offered a insurance policy from the FDIC where they can pay, let's say, a fee and basis points to protect those assets above 250,000. So immediately when you open the account, they give you the choice and say, do you want to insure that amount? Now, previously, you could have done that. You could have went to an insurer and did that, but I don't think a lot of people knew about it. They certainly didn't talk about it. Certainly wasn't the case, obviously, that most of these depositors at SVB had those insurance policies in place. So just make it easier for that end depositor to insure that value, and then ultimately it's on them, and they either take the risk of not insuring that above the 250, or they don't. Now, the other option is to do what they do today, which is the banks themselves pay that fee to the FDIC quarterly for that FDIC insurance below 250. So you could raise it much higher and have the banks pay a higher fee. But if you do it that way, then really everyone's going to be bearing that cost. And the question would be, is it fair for, let's say, someone who has a few $1,000s in the bank to bear that cost the same as someone who has a few hundred millions? Probably not. So I think the best solution would be, depending on your asset size, you can either choose to buy that insurance or not. And then ultimately, the insurance rates should be determined based on the riskiness of that bank. So if you want to bank with a risky institution, well, you have to pay a higher insurance policy if you want that amount above 250 insured. So this is very important. Hopefully, they'll come up with a good solution. You don't want to have an economy where people are worried about the deposits in their bank. That's like a fundamental thing that you need people to have. Some security that they think that their deposits will be safe. So hopefully, a good solution comes about. But there's no free lunch, so you can't just say there's a blanket guarantee for all deposits and there not be any consequences to that, because obviously you're going to have a moral hazard at that point. People will be taking extra risk. And of course, there's a cost to that. If the banks have to pay a higher fee, or someone has to pay a higher fee to ensure that, well, there's a cost to be bared. So they have to come up with a solution, I think, that's better than what went on. I think this happened all very quickly, obviously. And while it was somewhat predictable that another bank was going to fail, I don't think they thought it was going to be a bank the size of Silicon Valley or Signature would happen in a course of a matter of days. Now, what was causing this big problem with Silicon Valley Bank? Why did they have these big losses in securities that they thought would be safe, and were safe had they held them to maturity? Well, it's just the what happened in the bond market. We have the biggest drawdown in history for the U.S. bond market now, by far the longest drawdown as well, given that rise in interest rates from a historic low. So it's safe to say that there are many other banks in a position where they have big losses in these securities. The question is, are they going to get huge withdrawal requests? And I think that that Federal Reserve funding program is going to help with that, at least help with the fears of that. But it really exposes kind of the duration mismatch that exists at many of these banking institutions, where you have full access to your deposits immediately, but they're then going out and buying these longer term securities to try to get a higher yield on their money. So it's somewhat a consequence of low interest rates, 0% rates, and then the Fed hiking rates so aggressively. But it also kind of exposes kind of that mismatch that can go on, where they don't have to have that money available immediately at a bank, and really no bank has 100% liquidity. If everyone came in tomorrow to pull out their money, no bank is likely to be able to meet that. So that's just the reality of the banking system, and the historic losses in the bond market really expose that for places like Silicon Valley Bank. And of course, not everyone has a balance sheet like that, and as bad as Silicon Valley Bank, but I'm sure there's many out there where people are going to be more aware now that these losses exist. So Silicon Valley Bank wasn't very long ago where it was a pretty big market cap company, 44 billion. As you can see here, that had gone down significantly last year. Just the overall tech boom and then the tech bust. Silicon Valley Bank had really benefited more than really any other bank on the way up, and then they got hit hard on the way down. As obviously outflows are already happening before last week, and so the value of the bank is going down because they're doing less in activity, they have less deposits, and all the rest of it. But $6 billion as of the close of trading Thursday, and they never opened for trading on Friday. Their pre-market, it was trading down over 60%. But the regulators shut it down before that point, never opened for trading that day. So what is that equity going to be worth? Likely zero. If we look at the bonds of Silicon Valley Bank, they're trading, the last we heard it, let's say 30, 40 cents on the dollar. So if the bonds are not getting par, the equity is likely to be wiped out. So no bailout for equity holders in SVB or Signature Bank. They're going to have to take their losses. And interesting thing was, did anyone see this coming with Silicon Valley Bank in terms of the Wall Street analysts? They cover Silicon Valley Bank. They're supposed to know this bank better than anyone. did anyone say to sell Silicon Valley Bank here? And this is absolutely incredible, but probably shouldn't be surprising. There wasn't a single sell rating on Silicon Valley Bank in the across the banks that covered it, and the consensus rating was a buy. Consensus price target $338. And so this really should tell you everything you need to know about the value of these recommendations and these price targets, which is to say they have no value at all. So the idea that these analysts know more than what the market knows, obviously false. These analyst recommendations are always biased to the upside, always biased to the buy side. There's always many more saying buy than sell, as we can see here. And just hilariously is what happens usually after the fact. Whenever there's a bad news or bad earnings, then you see the downgrades. And here's kind of the most extreme example where we actually had three firms who covered SVB downgrade Silicon Valley Bank on Friday before the market opened, and they didn't even downgrade the stock to a sell. One was to a market perform, one to a hold, one to a pure perform. And this is when, if you had bought the stock that morning, let's say pre-market, you would have lost everything, because then of course the regulators took it over. Equity value is going to zero. So pretty incredible that even after you saw what had happened here, they still wouldn't issue a sell rating. And how is it helpful? Even if they did at that point, how would it have been helpful? Obviously, not very much. And what you usually see is that by the time that they do issue that sell rating, well, that marks some kind of low in a security by the time they get extremely bearish about it. So SVB, Signature weren't the only two to fail last week. You had Silvergate Capital, different type of failure. It wasn't taken over by the regulars. They announced a liquidation. They said they're going to have enough assets to meet all withdrawal requests. This is a crypto-related bank, but another one here was close to $6 billion at its peak in terms of market cap, and pretty much all of that wiped out, 99% decline. So what's the big fear today? The fear is of contagion, that this is going to spread to other regional banks. Again, the federal government not making it clear that they're going to do the same thing with the next bank that goes under. And so what we saw, at least on Monday's trading, is continued losses in a number of these regional banks. And nobody knows what the withdrawals are at these banks, but it's probably something significant. And now it's just a confidence game. Can they reinsure depositors at these banks that they have enough capital to meet withdrawals, that they don't have to worry about the amount they have above that FDIC insurance? Can they build that confidence back enough to really prevent another run on the bank? And no one knows the answer to that, because it's really a psychology thing. But it's not likely, I would say, that there won't be any other bank failures, that stem from this. It's just a question of timing, and a question of the size. Will it be another big one, or perhaps a smaller one that nobody's talking about? So if we look at these regional banks, and we look at the largest, let's say, weekly declines in history, there's an ETF that holds the regional banks. KRE is the ticker symbol. Last week was the fourth largest weekly decline in history for this ETF. And if you look at the top three, you'll probably be familiar with the dates. You had October 2008, obviously right in the middle of the financial crisis. March 2009, which is pretty much the week of the low for that bear market. And you had March 2020 during the COVID crash. So pretty rare to see a decline this big in the regional bank ETF here. And of course, this was actually followed on Monday with another big decline. I think it was down another 12% on Monday. So really it didn't stop there, but you're going to see extreme volatility back and forth, as you can see here, in the coming weeks. So we could either see a huge rally, we could see further declines. Really not very predictable. But if we look at years from now, obviously the odds are that these banks, hopefully the odds will be the same, that they're going to recover and we'll see better returns in the future. We won't see a complete collapse. That's obviously won't be good for anyone. So hopefully that's the case. But I think it's important to note that the 2008 example, 2009 example, and 2020 example were all really accompanied by extreme Fed action. So the Fed did not just watch that go on and say, we're not going to do anything about it. The Fed over here in 2008, of course, is cutting interest rates to zero, doing massive quantitative easing. It did the same thing during the 2020 crash. And today, interestingly, well, now we have that funding program for banks. So that's one thing they're obviously doing. But the big question is going to be, what will they do about further rate hikes? Of course, we've been hiking rates now for a year, and the balance sheet is shrinking. What will they do about that? And I think we'll get more clarity on that at the March 22nd meeting. But the expectation is that the Fed now is going to be easier than people thought before last week. So we had a big shift in terms of market expectations. If we look at Fed fund futures, what we saw before the news of Silicon Valley Bank was people were thinking that the Fed was going to hike 50 basis points at the March 22nd meeting, and then hike a few more times after that. Let's say a few more 25 basis point hikes. People were thinking as high as 6%. So Powell had this testimony before Congress, and his testimony was pretty hawkish, and people are saying, well, this means the Fed's going to just keep going. And what nobody really anticipated was the very next day, you're going to have this banking crisis. And with this banking crisis, I really think that's part of what's changing the game here. But the market expectations now is saying the Fed will hike 25 basis points in the March meeting and then really slow down. Maybe they do one more, but maybe not. And if you look at this forecast here, and take it with a grain of salt, as I always say, because these expectations change wildly from week to week or month to month. The market's essentially saying that the Fed is close to a peak in the Fed funds rate, and they'll be cutting rates pretty soon. And what a difference from what we saw earlier. The week earlier, where we had just really in the middle of last week, we had Treasury rates at across the board really at their highest levels since 2007. The 6-month actually its highest level since 2001. So 534 on the 6-month Treasury bond yield. You had a 2-year over 5%. So a very sharp move lower in yields after the Silicon Valley Bank situation. Really an extreme flight to safety. Here's that 6-month Treasury bill showing you highest since January 2001. That was really all in the expectation that the Fed is going to keep hiking and hike aggressively in the next few meetings, and that, of course, flipped. But this is something I want to point out here about the projections from the market about that Fed funds rate. It's been wrong time and again. So in March 2022, they were thinking that the peak Fed funds rate is going to be 2.75 to 3%. And as inflation continued to increase last year and the Fed continued its hawkish rhetoric, you had these expectations go up, 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 up. And here we are in February, 525 to 550. And now today, looking at roughly 475 to 5%, maybe one more hike, maybe two more hikes. So just keep this in mind. The market has consistently underestimated how far the Fed would go on the way up. And perhaps now they're overestimating, how quickly they'll cut rates, or overestimating, the speed, the extent of the decline. Nobody knows. These are expectations that are going to change wildly based on the data and based on what happens next. And the Fed themselves are not very good at predicting where they're going to be in a few years. So if you look at their projections for the end of this year in December 2020, they were saying the Fed funds rate was still going to be at zero. So they were really saying there's going to be no inflation problem. If you look at the minutes from back then, you'll just hear them talking about, we want higher inflation. We're worried about deflation. Inflation's too low. We have to get it up. They were saying in 2021 that yes, inflation's gone up, but it's transitory. It's going to come back down, and therefore we won't have to hike rates very much. And then, of course, what they did was go on their fastest rate hiking cycle since the early 1980s. So even the Fed themselves throw out all of these projections because it's all dependent on what happens next, and a lot can change in that regard. But very quickly, and I'll talk more about this in the next video, we had that CPI print today come in as expected. So another decline in the year over year CPI. And I think that's enough of a decline. We're down to 6% for the Fed to say we don't have to do 50 basis points, but let's just do that one more, at least one more 25 to maintain credibility. And perhaps we can soften our language and give some indication that we're getting close to a cycle peak. So if we look at this year over year CPI, I think it's really likely to come down sharply in the next few months. The main reason why I think that's the case is because if we look at year over year, commodity prices are really collapsing. So this is the time last year when Russia had invaded Ukraine. We had this spike higher in commodities across the board. Well, now we're comparing to that period of time, and that year over year rate of change for gasoline, for natural gas, heating oil, all of these other big commodity inputs are going way down. So I think you're going to see this number really accelerate to the downside, likely in the coming months. That will give the Fed further data to support at least a pause or slowdown in hiking rates. So let's see what happens there. But I think without barring a spike in commodity prices, there's a pretty good probability that we're going to see CPI much lower in the months to come. But again, I'm going to discuss that more in the next video. If we look at the markets, how did they react to the Silicon Valley Bank news? Probably not as bad as one might expect. We had the markets certainly down, certainly had volatility rise. Not huge. Really, we've just given back the gains on the year for the S&P. So remember, we had that enormous start to the year. And as I had noted here in early February, very interestingly, you had sentiment start to turn bullish again. So kind of remove what was really a tailwind for the market off of the October lows was negative sentiment. Well, that kind of flipped here. And now very quickly, we've given back the gains in the S&P 500. NASDAQ 100, interestingly, holding up much better. The Dow, which did much better than the broad market in 2022, actually down worse on the year. And we're seeing small caps really getting hit much harder on this latest move lower. They have a bigger exposure to financials and the small cap indices. So I think it's hitting that obviously harder there. But if we're looking at volatility, and this is a chart I like to show from time to time, we're seeing pretty good volatility here to start the year. So we have now 11 days, trading days with greater than 1% declines for the S&P 500. That's well above the average year. Last year, of course, we saw 63. That was the most since 2008, but we're on pace to be a pretty volatile year. So it's a volatile year, back and forth. S&P's roughly flat in the year, but we've seen pretty big swings in both directions. And very briefly, on Monday, we saw the VIX cross above 30. This was, following the news that depositors would be safe. You just had regional banks moving down significantly, a lot of fears in the market. So last year, every time we got above that 30 level, we saw the market come back, do a snapback rally, and volatility will come back down. We'll see if it does the same this time around. We did see a reversal in this VIX before the close yesterday on Monday, and so we'll see if that continues. But let's talk about another reason why the Fed is likely to do at least one more 25 basis point hike, and that's the employment report that we got showing the 26th consecutive month of jobs growth. We saw the labor force participation rate move up to 62.5%, its highest level since March 2020. So people coming back into the labor force, people starting to look for work again. That actually drove the unemployment rate up a little bit because people are now looking for work again, and you're not counted as unemployed unless you're actively looking for work, up to 3.6%, but still extremely low. We had the lowest level since 1969 in January at 3.4%. So the Fed looks at this and they compare it to that 6% inflation rate. Well, they're still likely saying inflation's the bigger problem. let's do one more hike at least to keep credibility. But really, this jobs growth, very good sign for the U.S. economy. There's still a lot more jobs out there, a lot more job openings than there are or are unemployed people in the U.S. So really, that mismatch between the job openings and people that are unemployed is still a consequence of how many people left the labor force in 2020. Number of reasons for that, but some of those reasons are starting to wear off. So the effects of the stimulus starting to wane here. You of course have now a sustained period of higher inflation, so people needing to come back to work to keep pace with inflation. So a lot of reasons pushing people back. And where are we seeing wage gains? Big in the leisure hospitality areas. So travel demand is really big. People going out again to restaurants and bars. We're also seeing big labor gains in the retail sector. So we're seeing people come back, and there's still a shortage in many of these areas. So we could very well see employment gains continue in the months to come, and hopefully it does. And again, my view has been on this that the anyone who's saying that the Fed wants or needs the unemployment rate to go up for inflation to come down is not paying attention to history. The spike that we had in the inflation rate up to over 9% was not due to the unemployment rate coming down. It was not due to just enormous amount of jobs being created. It was due to the increases in the money supply and increases in national debt. So as long as we control those two big factors, inflation is likely to continue to come down. And I think it will in the coming months, regardless of what we do, because as I talked about, that commodities year over year rate of change is really going to show a significant decline in the coming months. Let's shift gears, talk about the housing market. This is, to me, the biggest knock on the economy. It's definitely a housing recession. Question is, how deep is it going to get and how long will it last? If we look at the Case-Shiller index, we got the data for December, just showing a continued trend. So another monthly decline. This is lagging data, though, so we only have it as December. Here we are in March. If we look at real-time data from Redfin, actually now showing the first year-over-year declines in home prices since 2012. Not huge declines, but still meaningful change that we're seeing a year-over-year decline for the first time in over a decade. And if we break it down by city here, again, this is lagging data as of December. We're starting to see rapid slowdown in the rate of change. We now have two cities, Seattle and San Francisco, in this 20-city index that are down year over year. Every major city is down off of its peak level, so there's no major city hitting new highs in home prices. Again, this will take time to filter into the CPI, but it's going to be, let's say, at some point this year, we're going to see that CPI turn, the combination of home prices coming down, and as we'll talk about, rents coming down. So is this enough, these declines off of their highs? I would say definitely not. And the reason for that is affordability. Only 1 in 5 homes for sale in 2022 were affordable based on the median income. And so that's just a situation that's going to lead to a collapse in demand. So people can't buy a house, demand collapses, and eventually what you're going to see, as we've seen, is home prices come down to rebalance that supply demand equation. And if we look at affordability over time, it's gotten a little bit better, let's say, with the home price declines and mortgage rates coming down a little bit so far in the past few months off of that peak above 7% in mortgage rates, but still very much unaffordable. We're still the required housing payment in the U.S. To buy that median home is still above where it was at the peak of the last housing bubble. So you need to see this come down more to really rebalance that equation between supply and demand. And if we look at the monthly mortgage payment here, hit another record high in March. So extremely difficult to afford this increase in monthly payment because your income simply hasn't gone up this amount. So just a year ago, we're at over $2,500 now for the median asking price home. If you were to finance that, that's going to be a monthly mortgage payment That's just mortgage payment, not we're not talking about taxes, insurance, all the rest of it, which is going to drive that up much higher. A year ago, it's less than 2,000, and in 2020, we're talking about less than 1,500. So very big jump in a very short period of time. And it's all homes, really. We're seeing across the board affordability down across segments. Even the high end of the market is starting to come down. You're seeing fewer homes that are worth at least $1 million. So we had 8.6% at the peak in the housing market last June. Now we're down to 7.1%. And if you just look at the numbers, you look at the mortgage payment that you would need today versus, let's say, back in January 2020, well, it's pretty much doubled because home prices have gone up close to 40% and mortgage rates are up significantly. So that's doubling that mortgage payment, even for someone who could have afforded a $1 million home, let's say back in January 2020. Well, now they're going to need to have double to afford double that payment. Well, that's for most people simply not something they can do. So you're seeing a huge collapse in demand for the high end market as a result. Now, if we look at home prices on an annual basis, you'll see something a little bit different for 2022. We had the first real home price decline that we've seen since 2011. So it's been a long run of inflation adjusted increases in US home prices. I've argued this is the best evidence that we have, this along with the ratio of home prices to incomes, showing that this has really been the creation of a second home price bubble in the US. And this chart really tells that story. We're comparing here US home prices versus inflation, so adjusted for inflation. You can see here this is the peak of the last housing bubble, and we've exceeded it during the current housing bubble. So over time, it makes sense for home prices to pretty much closely track inflation over time. And when you see a big deviation from that on the upside, that's a situation that's not likely to persist forever. It makes sense that home prices should track inflation because then it's a reflection of inflation. Partly is people's wages growing, of course, materials, labor costs to build a home. So all of that should be inputs on in terms of how much a home should cost. And when you see this huge deviation above it, well, it means that home prices have gone up way more than people's incomes have gone up. And if we follow the same trend that we did after the last housing bubble, this is going to come down either with home prices coming down or going sideways for a period of time. But something has to give, and it usually gives with lower prices. So if we talk about home prices coming down, we're also seeing rents coming down. This is very important for that CPI. We're not seeing it just yet because, as we talked about, the CPI is a lagging indicator. But I think we're likely to see it at some point in the coming months where that CPI will flip to start to reflect the reality that rents are actually coming down now, down again in February, now up only 1.7% year over year with data according to Redfin. That's the slowest rent appreciation we've seen in some time. And importantly, this is a supply demand equation where vacancies are starting to go up. So more vacancies mean that there's more supply, and more supply means it's more difficult for landlords to charge higher rents. And so we're seeing, as a result of this, rent appreciation come down in a hurry, and actual absolute value of rent is coming down as well. So here in 2021, when rent growth was peaking, you had really a shortage of housing supply, a shortage of apartments, and now you're seeing just more vacancies is good for renters, or will be good for renters as rents either come down or that rate of growth slows. And there's another important thing that I think it's good to point out here is that there's more supply coming on the way. This is a chart showing U.S. housing under construction, looking at multifamily housing, and we're seeing a record number of multifamily homes with data going back to 1970 being built today. So more supply is coming in the future, and more supply should lead to hopefully lower prices for renters. If we talked about housing affordability, is a hugely important issue. You don't want housing to be unaffordable. It's unproductive good. So the Federal Reserve, your 0% interest rates, buying mortgage bonds, big mistake in my view. You don't want to cause a home price bubble. You don't want to cause rents to explode higher. It's not good for anyone. It's not an exportable good. Housing. You want housing to be based on people's incomes and affordable. So hopefully, all of these factors will lead to more affordable home prices in the future, whether you're a buyer or you're a renter. Now, what are people trying to do to combat these higher costs of housing? Well, they're looking to move, and where are they looking to move to? They're looking to move to places that are more affordable. So, according to Redfin, number of people searching for homes outside of their home location hit a record high in their most recent data point, and they're really looking to get out of places that are higher cost places like San Francisco, Los Angeles, New York, Washington, D.C., and they're looking to move to places that are more affordable: Miami, Las Vegas, Phoenix, Tampa. This is a trend. Dallas, Texas. This is a trend that we've been seeing for some times, but I think it's really accelerated with remote work becoming more of a possibility for people, and just obviously higher inflation really bringing costs more into focus for people. And as a result, we've seen just huge outflows of people out of states like New York and California and into states like Texas and Florida. And I think that's likely to continue until you get to the point where so much demand is coming into Texas and Florida that prices get closer to the places people are leaving. So, interesting thing to note there. Big trend in terms of where people are moving. And so, if we look at one of the leading causes of inflation on the upside, which for some reason no one ever talks about. So when the Fed meets again on March 22nd, if you watch the meeting, you should watch it. There's a lot of comedic relief there, where it's not intentional, but it's very funny the questions people ask. For some reason, the question they never ask is talking about money supply, and they rarely ask about debt or deficit. So they don't ask about the two major drivers of inflation on the way up. They never bring it up in any meeting. And what's interesting here, of course, is that we've seen a complete reversal in the money supply. So we had record increases in the money supply on the way up here. That was a big leading indicator that inflation was likely to rise and rise significantly, and it did. And now we're seeing the opposite. They've learned their lesson, hopefully. Money supply is actually contracting a little bit, biggest contraction we've seen with data going back to 1960, down 1.7% year over year. So, my view, this is likely to lead to lower inflation rates to come. That CPI will likely continue to come down in the coming months. Problem is, the money supply is coming down, but deficits are starting to increase again. They're up to 1.6 trillion. That's the highest we've seen in some time, and really moving in the other direction. So the federal government really hasn't gotten the message yet that they need to be focused on deficits and the national debt. And as a result, what we're seeing is that interest expense on that debt is moving up and to the right, 787 billion now. That's another new record. So we have more debt. We have a higher interest rate on that debt. So to service that debt becomes more difficult. But again, I think that the Fed is watching this number very closely. This will likely put a cap on how high they go in terms of interest rates. But it's going to lead to too many problems if they hike rates too much and leave them there for too long, because we simply have too much debt to service. So that's certainly a factor. But in the short term, bigger factor is that inflation number, and we're likely to get at least one more hike. So this is something interesting. I put a chart out about the S&P 500 ETF started 30 years ago, January 1993. And since then, had you bought that ETF, done pretty good. You had a 1,500% return, pretty good over that period of time. Had you bought Berkshire Hathaway instead, 4,060% return. But had you bought Apple when that S&P 500 ETF came out, 35,000% return. So of course, this is in hindsight. No one could have known that most of Apple's gains happened after 2009. Interestingly, before that, it was kind of in line with Berkshire and the S&P. And interestingly, Berkshire uh, really started to benefit from this Apple trend here after 2016. So for a long time, Berkshire Hathaway swore off technology stocks, did not want to buy them. Warren Buffett, would always say, "We're not buying technology stocks." That kind of changed with as people working for him, the guys that are going to take over for him, convinced him to buy this Apple in 2016. They've added to it. It's now by far their largest holding. Over 40% of their equity portfolio now is in the stock of Apple. So just exceptional in terms of how compounding and how quickly the math of compounding can change when you have this enormous run like Apple did, post the financial crisis. So uh, let's talk about Rivian. This is something I wrote about back in November 2021, kind of close to the peak of the mania. It was definitely the peak of the Rivian mania. Rivian's electric vehicle maker really didn't have any sales at the time that it went public, but there was a complete mania for anything related to electric vehicles at the time. And it drove this company's market cap up to over 150 billion, far higher than companies like Ford and GM, which had significant sales and profits. At the time, everyone kind of shrugged off the fact that Rivian was losing money. They continued to shrug it off for a little bit there, but then very quickly, people in 2022 started to care again about net income. And today, they really care about net income. And that loss obviously is growing. Sales have increased, but not enough to really alleviate these concerns about losing money. And so as a result, we've seen Rivian's market cap come back to earth here. 153 billion at its peak, goes down to around 12 billion today. That's over 90% peak to trough decline. And to me, this is a good thing. This is a reflection that the market now is being more realistic about its expectations. So you have these lofty expectations over here. Investors have it. Well, reality rarely meets expectations when those expectations are so high. So what I wrote back at the time is that investors were behaving as if the future had already happened for Rivian, which is to say they were betting that Rivian had already achieved all of these sales and profits that people were expecting to happen at the time. They were essentially saying Rivian's going to be the next Tesla, and that had already happened. And the argument I made is, well, that could happen, but Rivian has to prove itself, and any number of things could go wrong between now and then. And therefore, having that expectation today and paying for that in advance is a very risky proposition. And so today, reality much more grounded. We could debate whether it's worth 12 billion more or less, but at least expectations have come way down. So as an investor, ironically, you'd be much obviously better off thinking about Rivian today than back then. But this is when all of the demand from investors was occurring. And you could say that with pretty much any electric vehicle maker. They've all taken big hits across the board. Tesla actually holding up much better than most of them, but you can see a lot of them 80, 90+% declines off of their peak. So this is the other side of the mania that people don't talk about, but they should talk about because we see this time and again. It's a rush of FOMO on the way up. And the other side of that is the reality that there's a weighing machine on the other side, and companies over time are going to go back to what they're actually worth based on sales and profits. Let's quickly talk about bacon and eggs here. This is just a stunning stat, and I think this is going to improve here. Egg prices are already coming down, but I just had to put out this stat because it was just so remarkable to me. The increase, let's say you bought a dozen eggs and a pound of bacon going back in history. Well, over the past 3 years, the increase in prices for a dozen eggs and a pound of bacon was 67%, which was greater than the increase in the previous 18 years. So you had 18 years where the prices of these two, breakfast items were up 64%. It only took 3 years to exceed that, and it's 67%. So just showing you how quickly this food price inflation has gone up. And I think I expect this to this to come down in the coming months here. I don't expect this to persist. It's just too wildly too much of an increase. It's more than the increase in the money supply. It's obviously much higher than the increase in wages. We have a number of reasons for the eggs, as we talked about in terms of the shortages there. I think that'll be alleviated, but just remarkable to see such an increase in such a short period of time. And again, I think it'll come back down, but inflation has been tough. Food inflation has been very tough. So as we'll talk about at the end, I think that's coming down, and that's a very good thing. But just remarkable what we've seen. So quickly, I want to talk about Beyond Meat and DoorDash. Beyond Meat losing money as always, similar to Rivian. For a period of time, nobody seemed to care about that. There was actually what people call the burger bubble back in 2019, where a number of companies, Beyond Meat being one of them, skyrocketed during that period of time. Now, Beyond Meat's kind of back to reality, down 92% below its mania peak. It's actually below its IPO price from 2019, and its valuation today around $1 billion is back below that IPO pricing. So again, that's another example, other side of mania, and what happens when people care about profits and not just revenues. So DoorDash for now, still very much concerned about increasing that top line revenue, and the bottom line not so much. And DoorDash, interesting product. We'll see how it plays out, but it's an example of of what a company can do if it's not concerned with necessarily making a profit. The question is, will it be forced to be concerned, and then will that hit its growth rate? We've talked about Carvana in prior videos. I think somewhat of a similar situation here. Can DoorDash make this product profitable is really the question ultimately for investors. Investors still placing a pretty high valuation on this company, I think, with the expectation that they will be profitable, but it still remains to be seen. And I want to end, as I often do, with something that's simply incredible to me, and that's the fact that global container freight rates, so these are the cost of shipping 40-foot containers, has now come back to its levels from January 2020, so pre-pandemic. As you can see, 86% decline from the peak in 2021, and it's just remarkable to me that we're actually back to those levels, and that's very much a good thing. This is going to help inflation. This is obviously evidence that the supply chain issues are easing, so great to see that. And then in the agricultural space, we have fertilizer prices lowest since January 2021, as again, big input to food prices. I expect food price inflation to really come down significantly in the coming months. So great to see this year. Love to see this. And lastly, with wheat, it's pretty remarkable. Almost cut in half now off of the peak from last year. And with all of the fears that we had last year in terms of shortages of food, and I think there were some real valid concerns. Well, we're really seeing the opposite this time around. And again, I think in the coming months, this is going to be reflected into CPI. So wonderful to see food price inflation coming down. Hopefully that will only continue. So talked about a lot today. Let's end it right there. Have a great week, everyone. If you like the content, subscribe to the channel, and I'll see you next time. Thanks.